Thank you very much for joining us. My name is Jean-Pen. I'm the Global Director for Finance at the World Bank, and I'm also a member of the Board of Directors of the Toronto Centre. So welcome everybody to our fifth, last but not least, panel on the revised Basel Core Principle. I'm very happy to be moderating this important conversation, which will focus on climate-related financial risk. So maybe let me set the scene for 2 minutes before going to our panelists. So first, thank you very much to the Toronto Centre for organizing this and the last 4 webinars on this. The World Bank was one of the original founders of the Toronto Centre back in 1998. I've been lucky to engage several times with the Centre even before becoming a board member, and I've always been impressed by the impact of the Centre and the range of issues that it is covering. And in fact, since its establishment, the Toronto Centre has trained more than 28,000 financial supervisors from more than 190 countries and territories, with a focus on building a more stable, resilient, and inclusive financial sector. The mission of the Toronto Centre is sponsored by Global Affairs Canada, Swedish CEDA, the IMF, and other valued international partners. So I'm particularly happy to be moderating this session, as both the Toronto Centre and the World Bank really pay a lot of attention to climate risk as an important supervisory challenge with relevant implication for global development. And we both congratulate the Basel Committee for amending the core principle for effective banking supervision to reflect on climate-related financial risk. Now, climate change poses both physical and transitional risks that could impact the safety and soundness of individual banks, with broader implications for the banking system and financial stability. And in response, targeted changes to the core principle have been introduced to explicitly include climate-related financial risk and to promote a principle-based, and I insist on that, approach to enhancing supervisory practices and banks' risk management. Now, the core principles are universally applicable, and they emphasize that banks should understand how climate-related risk drivers may manifest through the traditional financial risk, such as credit risk and operational risk. Banks are also expected to recognize that risk could materialize over varying time horizon and implement appropriate measures to mitigate them. On the other side, supervisors are also expected to incorporate climate-related financial risk into their oversight of banks, assess banks' risk management processes, and require them to provide information that allows for an evaluation of the materiality of this risk. And this is where the principle-based and proportionate approach comes back. But given the degree of heterogeneity and evolving practices, both the bank and supervisory practices may consider climate-related financial risk. So I'm very lucky to be joined by distinguished panelists. We will examine the inclusion of climate risk in the updated core principle, highlight why both banks and supervisors should adopt flexible practices to address this, but also share their own experience in their countries. So good afternoon, Elsie. So Elsie Ado-Awadzi is the Deputy Governor of the Bank of Ghana. Elsie, very nice to have you. I think we've discussed climate risk in the past already. So very happy also to see the evolution over time. And Shahid Muhammadze, who is the Executive Director of the Central Bank of the Republic of Azerbaijan. So thank you for joining us. Very different perspective, but also very important role because your country will host COP29. So even though you're not directly in charge of that, I think that also puts things in broader context with the COP29 focus on finance. So welcome to our speakers. You have seen their bios. I will not go in more detail. Our objective today is to have 3 rounds of questions with very sharp answers from Elsie and Shaheen, and then we will open for discussion, so you can share your question on the chat using the question and answer, and then I will moderate this. So let's get started because we have a lot to cover, and I will start with you, Elsie. So in Ghana, how are you addressing climate-related financial risk, and what are you doing as a supervisor to engage your banks on this? Elsie.
Thank you, Jean, and thanks for the invitation, Toronto Centre, and it's great to be here with Shaheen and everyone. So at the Bank of Ghana, we understand the importance of climate-related financial risk as a key risk, which is already actually impacting, to an extent, banks' balance sheets, but we foresee that that could be a bigger problem going forward. And so we have fully embraced the Basel Core principles, in particular the principles that were recently included, that are just sort of zeroing in on how the supervisors address the climate-related financial risk. But let me step back to 2015, 2016, where we began to see this and started to conscientize the banks around how to manage ESG-related risks, right? And we then developed a set of ESG-related banking principles. We call it the Sustainable Banking Principles, together with the banking system and the Environmental Protection Agency, Authority of Ghana. And so this was the first time that you were seeing sort of like a bottom-up approach with the regulator, with the banking system, and supported with a technical agency to develop this set of ESG-related principles. We did not stop there. We believe that when we launched those principles in November 2019, it was the beginning of getting banks to report on these risks and to tell the public how they're managing these risks. Fast forward, in addition to all of that, where now we have banks reporting on ESG risks, we developed a climate-related financial risk directive, which is like a rule. And this has benefited tremendously from the work at the Basel Committee and the Basel Consultative Group. And so we exposed a draft of this in early this year. We got a lot of good input from the banking system and from the public as a whole. And we're currently finalizing our rules on that. This really incorporates all the best practices we know so far in this particular area, and we expect the banks to start complying with this next year. Now, we haven't stopped there. We have provided a lot of engagement forums with the banks to understand where they are. We've conducted a survey recently to understand where the banks themselves are in terms of beginning to incorporate climate-related financial risk in their governance structures, in their enterprise risk management frameworks, and basically where they think the gaps are in terms of being able to comply with the rules as we are now finalizing. And we're learning a lot from that process. And together with the International Finance Committee, International Finance Cooperation, the IFC, we're providing a lot of capacity building to the banking system to be able to bring them up to speed on this. So that's what I'll say as a start. And as we go along, I'll be able to share more examples of what we're doing. Thank you.
Thank you very much, Elsie, for this overview. And a lot is happening indeed. So we'll come back also now that relates to the broader stability discussion in Ghana. But both supervisor and banks are active and a lot of capacity building. I think it's really important to emphasize the capacity building angle. So Shaheen, same question to you. How are you addressing climate-related financial risk in Azerbaijan? What's your approach as a supervisor and with the industry?
Thank you. First of all, I would like to thank the Toronto Center for organizing this webinar. It's such an important topic, and it's really a pleasure to be here. Unfortunately, we didn't have so much track record as Ghana. If you come to the question, we just recently developed our roadmap in 2023, covering 3-year period, but with the organizational structure within the central bank, we create a special unit for ESG management. Within this ESG project, we have 4 main directions, and due to the accelerated program, we are conducting around 10 to 15 projects at the same time in parallel. So what are the main directions? First of all, we realize that, we understand that there is the lack of capacity within the country, within the financial sector. And our first goal is to create this capacity within the country. So with the discussions with the peer countries, we realize that it's not the only issue in Azerbaijan, but also in some developing, in most of the developing countries as well. We lack the skilled labor in the market and also the technology, and also the third parties who can be the assurance companies or any kind of outsourcing companies are lacking behind the developed countries. That's the first our direction that we think is important, and we are conducting several trainings. Not we outsource the trainings to the financial sector employers, also to the private sector in order to create the awareness on this topic. The second direction of us is closing the regulatory gap in this field. We also started with publishing the principles, as Ms. Ellis said. We published our principles in the beginning of this year, the ECG principles, and we changed the corporate governance standards, not only in the banks, but also in the insurance companies. As we are the mega regulator, we are trying to make it parallel in insurance and in banking sector as well. So for us, it's not only the Basel core principles, but also in insurance core principles. There are some ECG elements incorporated already that we should also apply within our jurisdiction. Also in monetary policy framework for 2025, we declared that we are thinking about integrating climate risks to our monetary policy instruments. We are working on integrating the ECG principle to our compulsory insurance products. It will be mainly physical risks and liability risks, not the transition risk in the first phase. But in the next phase, probably we are going to integrate also the transition risk elements to the products. Also, we did some actually change in the regulation, like increasing the loan to value of the electric cars compared to traditional cars, but it is a fragmental change. We understand that we need a more comprehensive approach, and one of the elements of this regulatory, like closing the regulatory policies, is creating the taxonomy. We started this year working with the World Bank to create our local taxonomy, and I hope we are going to finish it before the COP 29, and then to integrate it to the financial decision making of the financial institutions, both banks and insurance companies. The third direction of Central Bank of Azerbaijan is integrating risk management to the capital planning of the banks and to the supervision cycle. And we are conducting 2 projects with IMF, the data project and one the stress testing project. And the last direction is the transparency for us, which is quite important. We published our first ECG annual report this year, and since next year, we are going to make compulsory the disclosure part for the banks. And right now, another project that's conducting within Central Bank is creating the reporting system between banks and Central Bank of Azerbaijan.
Thank you very much, Shaheen. So I see some attendees saying that they don't see Shaheen. I think it's an issue of bandwidth on your side, because technically it works, and I've actually been able to see Shaheen all along. So maybe you want to check your network and your connection. So before turning for the second round, starting also with Elsie, maybe a couple of words that were there, or concept, very important. First is the different types of risk: physical risk, transition risk, and also, so there's been a big discussion on this, the difference between advanced economy and emerging market, not necessarily confronted to the same kind of risk. Thanks, the two of you, for having flagged the disclosure, so ESG, but also there's a big push on disclosure, including in the context of the ISSB new standard. You mentioned taxonomy, really important, and something that we are seeing also coming very strongly in the banking sector, but also increasingly in securities market. And what are the taxonomies as an element also to guide the financial sector? And you mentioned stress testing, which is also an important tool, and increasing attention to stress testing and how to check that. So thank you very much for having already put quite a bit of markers down going forward. So Elsie, let me go back to you now. We have those principles for the effective management and supervision of climate-related financial risk. What is your experience with implementation of this principle? How useful have they been? But also, what has been the challenges for both the supervisor and the bank in getting concrete on this and making things happen on the ground?
Sure. So like I said before, we have already drafted a climate-related risk directive, which is a rule, and we're still finalizing it. It's gone through all of the public consultations. Now, that rule or the directive tries to implement the new principles, right? The new Basel core principles related to how do you manage climate-related financial risk. And so we're a bit far from actual sort of seeing how it plays out, right? But from early indications from the banking system through our consultation, we have the sense that the rules or the new principles are principles-based enough, such that incorporating them in the rules that apply to banks in Ghana especially in relation to governance, in relation to internal control, in relation to disclosure, isn't really a big deal. We don't anticipate that the cost of compliance is going to be too high. However, I think where we begin to see challenges has to do with how do we all wrap our minds around the data issues, right? And this is a national issue, it's a nationwide issue. It's not a banking sector only issue. Across all of the key sectors of the economy, there's a data related issue. There are issues relating to scenarios, and from a national perspective, do we all understand what the various scenarios could be from a physical risk standpoint, from a transition risk standpoint, who has the data, you know, and how can we get access to the data as quickly as we need it for the banking sector, right? And so there's all that work going on at the national level, sometimes not as quick as we want it, specifically for the banking system. So therein lies a challenge about a slight sort of timing consistency between all of the national level issues and work that's ongoing versus the work that we're going. And we're benefiting from all the guidance from the Basel Committee, from the Network for Greening the Financial System, for the Basel Consultative Group. And so we're feeling ready, but we recognize that there are gaps in terms of the overall national preparedness and readiness. So we're working very closely with the banks to see how we plug some of these holes. We're getting, as we speak, some technical support from the French Development Agency to map out sort of a baseline climate study for the country, right? That would also help to develop some scenarios going forward. And so we anticipate that that's going to be very helpful, not only for the banks in terms of their disclosures, but also for us, also in terms of how we supervise them and how we run our stress test models and such. Another key issue has to do with the taxonomy issue that Shaheen mentioned, and we're, again, at the national level, there's work on developing a green taxonomy, right, for Ghana. And so we're playing in tow, but that also makes our work very, very challenging sometimes, but then we're understanding that we need to convene various stakeholders, we need to be part of various stakeholder engagement groups at the larger level, and we're working along with that. So again, we're getting close to rolling out implementation of these principles. Hopefully the rules will kick in next year, early next year. The banks are already have been sort of exposed to what the rules are, and we do expect that there's a large amount of that they can already start complying with, but we need to sort out the data issues very quickly. Thank you.
Thanks, Elsie. Maybe quick follow-up, just for clarification. When you say rules, this means that they will be binding, even though they are principle-based, correctly?
Absolutely, absolutely.
Yeah.
And
Okay.
so we have customized that because they're rules, the principles based. We believe that they're capable of being customized on a proportional basis, right, for our context. And so yes, we, unlike the ESG principles, which are voluntary, and banks are strongly encouraged to comply with or explain. And so invariably all the banks have complied with. For this particular one is going to be a rule, and we're going to embed it very firmly in our supervisory work with for the banks. We have also had to think of how we apply this to smaller banks, especially the rural and community banks. Now, the challenge there is adopting a proportionality approach doesn't necessarily mean less rules, right, for these ones. Because if you think about it, these are some of the closest to the real action. I mean, the community banks, the rural banks, they are in the farming areas where we're experiencing droughts and etc. And so they are sometimes even hardest hit by climate change. At the same time, their capacity to be able to do the work that is required and manage these risks may not be as strong as that of the bigger banks, right? Who sometimes may be a little bit more removed, not altogether, but a little bit more removed from the first impacts. And so it's a bit of a struggle how you think of proportionality in these cases, right? But evidently we're guided by what is reasonable to do and where the risks are for these small banks and what's reasonable to expect of them in the circumstances.
Thank you very much, Elsie, and thank you very much for that discussion on the complexity of proportionality. It's not just against capacity, it's also around the materiality of risk. And indeed, sometimes the smaller bank, in particular on the agricultural side and the exposure to the climate risk related to that is really important. So thanks a lot for highlighting that, which I think is a challenge that we are seeing in many jurisdictions. And this is also why we organize this event, to share experiences and practices, etc. So Shaheen, similar question, very different kind of context also. Your country is very different from Ghana, so very keen to understand how you're planning to implement the revised core principle, use the principle, and what do you foresee as implementation challenges, including this element of what does it mean to be proportionate? And I'm very curious also of your views on the data issue, which Elsie highlighted, which is a real challenge across the globe, actually, but even more so in emerging markets. Shaheen.
Thank you for the question. I don't think I will have different answers for the probably we have kind of okay, the countries are different, but I think the problems are common for both countries. As I said before, we already incorporated it, the ECG principles to the corporate governance of insurance companies and banking companies, which is the one of the main principles of the BCP. And right now we are running the RBS project, risk-based supervision project with World Bank as well, which is not only about the ECG risks, but also the changing structure of the supervision. And we see this opportunity to incorporate the ECG principles to the risk-based supervision. And it's not only about the developing the risk profile of the, like, including the ECG elements to the developing the risk profile of the financial institution, but also we are thinking about integrating in ILAP, ICAP, whenever we are going to include it in our regulation. The main challenge for us, except lack of capacity within the financial sector, also within the Central Bank of Azerbaijan, I would say the same, the data issue. While comparing to the traditional risk realization process, in climate risk, it takes much more longer periods to materialize, which we need more time series to do the stress testing or analyze even the exposures. Also, the channels of this risk are quite complex comparing to the traditional risks. Like we know that there are credit market, liquidity, operational risks, but ECG risk is not a standalone risk. It is affecting through these risks, and the trend and the channels of physical risk, transition risk, and liability risk are quite different, which make it complex to quantify these risks, and which make it complex for data collecting from the financial institutions, and which are not readily available. As Ms. Ellis said, it's not only about the financial sector. Also, while developing the taxonomy, the thresholds of this the boundaries between green and brown, we realized that it's not only the data issue within the financial sector, but also in the relevant agencies for relevant subsectors of economy, which we see that, which is as a green above some thresholds. So to sum up, it means we need more granular data, which we don't have right now. And it's not only about the data issue, even incorporating the BCP principles. Let's say we quantified, we succeed on applying the BCP principle to the banks. When we have these exposures, how we can mitigate them? It's also another question. When you have less developed financial market with lack of adequate financial instruments, it's not that easy even to mitigate those risks. And as a mega regulator, we have this advantage to incorporate the insurance and through reinsurance to transfer these risks to abroad. But still, it's the one of the main challenges for us, the data, the capacity, and the mitigation of those risks.
Thank you very much, Shane. And thank you for the two of you for flagging that, of course, the financial sector supervisors are doing their job, including implementing the global standard, but they cannot do it on their own. And the connection with the broader discussion on climate issues and environmental development is a system-wide one. And sometimes you have a dependency, but also how to move even without everything perfect. And Shane, thank you for highlighting the connection also between the banking sector and the insurance sector. So that's why it depends a lot on the development of the non-bank financial institution, and it's very uneven across country, in particular in emerging market. But indeed, the issue of resilience from an insurance perspective and what kind of products can also be put in place to help mitigate some of these risks really important. So thanks a lot for highlighting that. And also, so sometimes it makes it even more complex, but I think it's really important to understand that it cannot just be looked at from a narrow banking sector perspective, and this connection with the rest is really, really important. So first, thank you very much to the 231 participants connected. That's really, really excellent. Thank you also for already sending questions, so we'll turn to them. So we are going to go third round, but I see that Elsie wants to add something in addition to the question that I asked for us. So let's first your reaction, and then we'll go to the third round. Elsie, to you.
Sure. I just wanted to flag the issue about the insurance sector and the non-bank sector very, very, very quickly, because it's not only the issue of resilience of the insurance sector is critical, right? Because they provide a safety net, a huge safety net for managing these risks nationally and in some cases regionally and all of that. But there's also a lot of interconnectedness in some of our countries, right? Between the banking sector, the insurance sector, the capital markets. And so to the extent that the risks are, say, on the insurance sector and not well managed at that level, it can very quickly snowball or spill back to the banking system, because you might have groups that have insurance firms and banking operations, etc. Or there are other channels of interconnectedness in our countries. And so it's actually very helpful where there are multiple regulators and supervisory authorities, that there's a coordinating mechanism for the financial system's resilience, from a climate financial risk perspective. We in Ghana have a financial stability council that has all of the various financial sector regulators there with the Ministry of Finance, looking at some of these across the financial system broadly. But if you operate in a system that doesn't have such coordinating mechanisms, it becomes a bit of a weakness, right? And it's got to be carefully managed so that these risks across the system are managed carefully. Thanks.
Yeah, thank you. I very much agree with you. So, I mean, every country should have this kind of financial stability systemic issue council. I mean, that's now an expectation. I'm not sure that all of them look at it also through the climate risk lens, but more the classical stability. So thank you for flagging that, because indeed there is a real issue of that coordination. So that's one angle. The other angle, and you were mentioning the agri sector earlier, is that sometimes the customer, when they don't have insurance from an agri perspective, then also that raises creditworthiness issue from the banking sector. So that's also another element in terms of the credit profile of some of the customer in the agri sector. Okay, so let's go to the third round, which is a bit more forward-looking. So Elsie, let's start with you. Is there anything based on your experience today in terms of management and supervision of climate related risks where more guidance is needed, where you see an obvious gap? And in that case, what could it be and how could it be addressed, not just through Basel, but also you mentioned a wide range of players, NGFS, the development partners, etc. So what do you see as something on which the international community needs to focus a little more?
Mm-hmm. Well, yes, thank you so much. I mean, there's a lot of work that has already been done, as you say, and that sort of peer learning that's occurring at the level of all of these networks, I think it's really to be applauded. There are gaps at the national level, particularly for emerging economies and developing economies. And this is where I believe that, we can get the help of regional development banks, we can get the World Bank and others looking at. And this, for example, has to do with the scenario analysis, right? How do you help? And it may be that across, at least at the regional level, it may be easy to formulate some standard type scenarios, right? Globally, maybe a little bit more challenging, but at the regional level, at least, I can foresee how help could be forthcoming in that area, right? And so I implore all of the partners available to see how we can support at that level. Also, like I said, often, even if the financial sector regulators are ready, or maybe the central banks as banking sector regulators are not even sometimes completely responsible for the financial system, you find that there are other authorities that are critical in the nations that are not ready, right? How do we get them all? And I think the COPs, the COP 28, COP 29s, and I'm looking at Shaheen now for Azerbaijan. They are helping to bring together all the major policymakers, that have something to do with this. But I think we need more traction and we need more urgency at that level, because a lot of what we need to make our work successful depends on how quickly in the various countries they are able to do the work, all the national authorities. And I feel like sometimes the push is coming from the banking sector regulators because we know what the obvious implications are for banks' balance sheets and for stability of the financial system. But the rest of the ecosystem feels, well, we're working on it. We can take our time. So how do we get a lot more pressure, and urgency for all the other actors to do what they need to do very quickly so that we can get the baseline to be able to do our work and all of the institutional arrangements in place to do our work.
Thank you very much, Elsie. So let me use that opportunity for one additional comment. So what we see in our work is also that balancing between thinking about risk, which is the job of the supervisor, but there is also the whole discussion on mobilizing private capital to finance the climate-related investment, and a lot of expectation, but also sometimes pressure on the supervisor. So we just published a document. It's called Finance and Prosperity, the first edition, 2024, and we have a chapter on that, including what are the flows, and there are significant concerns on the flows, but also the instruments that can be used, and some have proven working, but on a lot of them there is a big question mark. So that's also part of the debate on what's available for the supervisor, and not all of that can be done by the supervisor. Some of it must be done by other public authorities, so quite important also to keep that in mind. So Shaheen, last question of the rounds for you. So how can supervisor build capacity in supervising climate-related financial risk with that traditional mandate, but also that complexity of getting to climate? And this is about the capacity of the supervisor, but also the capacity of the financial institution. So what's your view on that? What's working well and what are the needs?
Thank you. First of all, I would like to add this to the question asked to Elise. I would say I want to share our experience about the electric cars that I mentioned before. We increased the loan to value, and the government decreased the custom tax for electric cars, and it worked well. So now we realize that lots of the proportion of electric cars that come into the country is increasing sharply. So which is for us, it's the proof that when the fiscal policy and the macroprudential policy works together, then we can achieve something. Otherwise, if there is no any demand, if there is no push from the government to increase the demand for the green instruments, the supervisors alone cannot achieve anything. So it should be the collective approach and collective some measurements from both government side and from the finance sector side. So our work is just to prepare the financing for the demand, not creating the demand. That's the main point that I would like to highlight. Otherwise, without carbon taxes, etc., I don't think we can achieve so much in this field. And regarding your question about the building capacity, I would say it's the learning process. We understand that we cannot supervise everything in this field perfectly in the first years, and we realize that we understand that there is no magic stick that can change everything in one day, but there can be some enablers which can smooth the process. And in our view, the first enabler is working closely with the associations, international associations. By the way, we are the part of the SBFN community, which helps us a lot in closing the deficiencies with peer-to-peer learning or transferring know-how. Of course, it's a community of emerging countries, but still helping each other. I think we can achieve a lot, because it's not something to create the vehicle, to create the wheel. It's not the only problem of one country. The risk can spread from one country to the other country, mainly in the fiscal risk or through the trade communities or trade activities. The second one that we realize that we are lacking is the technological, using technological solutions within part of our subtext, and we think that increasing this know-how or transferring know-how from developed countries is essential for building capacity, mainly in the supervision side. And also, we are working with more consultants for developing capacity of the supervisory staff. Without labor force, everything will be on the paper. While this developing the taxonomy, in the first stage, it was around like 300 pages, and my first impression was like that even if we develop the best taxonomy in the world, and still we don't have any green loans or green financial instruments, it's not going to work. So your regulation and your supervision should be aligned with the capacity of a financial sector. Otherwise, it will be on the paper and you will have just say, okay, it's the click that I did my job. But I don't think our job is just to make good supervision or good regulation. I think there is market failure in this field, and the main job of the regulators, or in our case, we are both regulator and supervisor. That's why I say also the regulators. I mention also the regulators. Our job is to create the environment when there is market failure, and we should intervene and bring all the parties together, which also I said it's a learning process and takes a lot of time. And except this, for the, let's say, for to make it sustainable for 15, 20, 50 years, we include this topic in our financial literacy programs, and we will have some discussions with Minister of Education, and hopefully we will succeed to bring these topics to the university curriculums, and to make it more sustainable. And we see this as one of the essential enablers for our community and for our financial sector.
Excellent. Thanks a lot to the two of you, and thanks a lot to the audience, because we have lots of questions. I'm not sure we are going to be able to address all of that. And thanks, Demet, for helping me multitasking at the same time the question to the bank. So let's start with a very specific but very important question, which is, can you give a little more example of specific risk that you see in your jurisdiction to make that a little more concrete? So what are you particularly looking at in Ghana and in Azerbaijan in terms of climate-related risk, so that we ground this discussion a little bit? So maybe let's start with Shaheen, and I'll come to you, Elsie. Shaheen.
Okay, as from, like, what risk we mentioned, there are physical risk, transition risks, and let's say liability risk, but it's maybe more micro risk. In Azerbaijan, probably it's different in Ghana. In Azerbaijan, Baku, the capital, is incorporating around 40% of the economy. So if you look to the loan distribution geographically, we see that the Baku region, Baku and outside of Baku, is incorporating around like 60–70% of the loans, which means we are not so much fragile to the physical risk due to the geographical location and the weather conditions in Baku. We are concerned more about the regions, which means the SMEs are more vulnerable in Azerbaijan. But if you look through the financial stability point of view, the physical risk is not that much in our priority, I would say, comparing to the transition risk. Well, so why transition is important? I would just I want to mention about the economic conjuncture of Azerbaijan. We are the oil-rich country, and 80% of our exports are coming from the oil, and around 40 to 45% of GDP is comprising from oil GDP. So it means the transition risk is more important for us. The more the global world is going to countries going to use more green technologies or make the economies more green, the less there will be demand for the oil. So it means tomorrow is late for transition our economy from oil to the let's say, or more diversify our economy. So we are more focusing now on the transition risk to prepare our financial sector to the new reality, and at least from private sector to to direct them to more green fields in order to compensate the losses from oil sector in non-oil sector.
Thank you very much, Shane. So, Elsie, to you, and you have a fan club online, so congratulations to you. So, specific type of risk in Ghana, which one are you the most worried about?
Okay, I think we're worried about both. So on the physical risk, we see it already playing out in some very extreme weather patterns, right? As we speak, we've had a drought up north, for a while, and it's been very disturbing, and it has implications on agriculture, implications on other sectors. And we see this playing out through general macroeconomic indicators, right? Sometimes, food price hikes, embedded in general prices at some point, sometimes even unemployment, sometimes migration from these parts of the economy where you have droughts or floods and etc. And sometimes the rebuilding efforts also have an implication for the fiscal, right? And so you see that from that channel. All of these already have implications back for the banks because it affects, the ability of their customers to keep up with their loans and etc. And then you have the direct physical risk where perhaps a bank has lent to a farmer, right? And then as a result of extreme weather patterns, that farmer is unable to pay back their loan. So that's a more sort of direct impact as well. So you see these playing out already. And then you have also the transition risks where as a resource-based economy with oil and gas, mining of all sorts of minerals, forestry, you see that it is getting more difficult for investors to fund these, the continued production from these sectors. And so you're beginning to see assets sometimes being abandoned or not being exploited in the same manner in which they've been exploited in the past. All of these are funded by banks. And so you can see what this means for migration of loans and etc. So, all of these are playing out, although we envisage that in the not so distant future, if nothing is done, this could be much worse. And if you don't have the banks already begin to incorporate these in their risk management practices as well as in their disclosures, then you're going to wake up and oops, okay, we have all sorts of risks already playing out, without the necessary prudential sort of norms having been observed, right? So if it's additional loan losses coming up, how have these been provisioned for in a way that is not traditionally done, And so this is where we're coming from to say, these are not different risks. These are all risks which are a bit different from what we're used to traditionally, but in fact, they affect the same the same indicators that we're concerned about, whether it is macro indicators, whether it's micro level indicators for the industry or for any specific bank. In Ghana, we reckon that all the key sectors of our economy are at risk. And therefore, when we launched our ESG principles, we wanted banks to already apply them to 5 key sectors of our economy. These are agriculture, forestry, construction, oil and gas, mining, and etc. So that we wanted them already as far back as 2016 to start thinking of how these sectors were at risk. And we're seeing that those risks are evolving very fast. I do hope that that's a good explanation. We could spend a lot more time, but
No, this is a very good
just
point. We are
explain.
trying to get this grounded, and someone made a comment on litigation risk, and there is actually a very interesting paper from NGFS on litigation risk. So for
Absolutely.
those interested in that, I recommend to have a look.
Mhm.
So I'm going to combine several questions in one that is by then becoming a bit complex. It's the prioritization and hierarchy of mandates and function. So the first mandate of a supervisor is about core stability risk. Climate comes to that. So what's the relationship between climate and the stability risk? You've begun to answer a little bit of that. But when you have, I mean, I've Ghana in mind, having worked a little bit on the financial stability challenges in Ghana at the moment, how do you prioritize that? But then we also have a lot of comment on something which is really important, which is financial inclusion, access to finance, in particular for SMEs, because on the one hand, as you said, LG, earlier, the agri-SMEs, they are very exposed, so they become a higher risk. And at the same time, you don't want that what you're doing on the, you want to avoid the so-called unintended consequence where the push on the climate leads to less access to finance. So again, very concretely at the national level, how do you bring this together, but also how do you help on this risk assessment? Because it's really important also to ground this even without enough data. So how do you do that concretely, and what are the challenges? So Elsie, maybe let's start with you, and I'll come with you, Shaheen. And Shaheen, you may have seen question also on the chat on the role of the institutions in Azerbaijan in terms of who's leading the risk assessment, what's available to help inform investment decisions. So maybe you want to capture that when I come to you. So Elsie, let's start with you.
Sure. This is, of course, a very important question, but I think that if the supervisory authority also happens to be a central bank, then it's even more complex.
Yes.
Because then you're starting with your primary mandate, right, of price stability, and sometimes you see some tensions. But from the financial stability mandate, as you say, you want to start with supervision, regulation and then supervision. And you're supervising to mitigate the risks to safety and soundness, right, of an institution, and then ultimately the stability of the system, of the banking system or the financial system. If you have, and so there is no prescription as to what risks you should keep in mind. I think as supervisors of the banking system, most of us have adopted a risk-based approach. And if you're adopting a risk-based approach, you don't have a finite list of risks. The first order of business is to keep your eyes wide and identify all the risks which are playing out or which could be playing out. And so one key test of a good supervisor is, are you able to anticipate risks? And are you able to get the regulated institutions to begin to think about how they manage those risks, right? All towards the same goal of promoting safety and soundness and financial stability. So I don't see that as a different, it really isn't a different matter. It's a matter of new emerging risks and being able to understand those risks and measure those risks and understand how they're evolving and how they're transmitting and therefore what tools are available to mitigate them. So I think it's the same thing. How we have organized ourselves at the Bank of Ghana is that within our supervision department, we have set up a dedicated desk called the Climate and Sustainability Office, and with a team of staff there, and their work is really to do this on a full-time basis. So at the larger supervision level, they're dealing with bread and butter issues right now, like the impact of a government debt restructuring. Right? 2 years ago, started 2 years ago, and now we're dealing with the Eurobond restructuring. They're dealing with that. They're dealing with rising credit risks as a result of a macroeconomic crisis from 2020 and the lagged effect thereof, and so they're dealing with the bread and butter everyday stuff. But within that department is also a group that is dedicated to understanding what this emerging risk is, right? And then helping to formulate the right policies, the right regulation, and even supporting the examinations team as to what new tools to put in place to measure and track these risks. And so we feel that this is all part of what we're required to do. And the litigation risk issue you talked about, if you read the NGFS paper, I mean, the failure of central banks or regulators to actually anticipate that this is a risk and to begin to address it is a risk, it's a legal risk that you're seeing some central banks being sued for. And so we're taking this very seriously as part of our core mandate of promoting financial stability. Thank you.
So has Shaheen disappeared or did he turn off his camera? Shaheen, are you connected? Okay, so while we wait for Shaheen to come back, Elsie, maybe in a couple of words, financial inclusion,
Yes.
which is a different mandate, and you have that issue of here. How do you deal with that issue in particular when it comes to SMEs? What are you doing as a supervisor?
Absolutely. So that is something that's so dear to my heart. And I particularly don't see it as a separate mandate, but just for completeness, the Bank of Ghana's mandate includes also support, and I'm reading now, supporting the general economic policy of government and promoting economic growth and development, and the effective and efficient operation of the banking and credit system. So it's not a definite financial inclusion objective, but if you think of what we're trying to achieve as a monetary authority or as a regulator of the banking system, and you know, an authority that has oversight of the payment system, we understand the importance of ensuring that our informal sector is fully formalized, right? It's important to us that the banking system thinks of itself not as a provider of credit to those that are already strong and the large enterprises, but also a sector that needs to grow itself. The banking system itself, if it wants to grow and stay resilient, it must see that it makes business sense to ensure that it's creating a pipeline of clients and consumers that need access to finance at every level, so that they can carry out their own economic activities. And so we stress the need for banks not to just look at the well-established you know, businesses. We stress the need, still being prudent in lending and all of that, but to think of how they customize their lending products to SMEs and to marginalized groups. Now, when it comes to climate-related financial risk, we are of the view that the whole transition to a greener economy that would help also to manage these risks requires funding. And so we expect that as banks lend to sectors of the economy that have a big impact in terms of the outcomes that we're looking at, they're more conscious about how they lend. Is the lending going to support more of the activities that would complicate these risks or would help to mitigate these risks? Number one, we don't think banks should just lend because they need to lend, but in lending, how do you make decisions that are helping to promote a greener economy so that ultimately the climate-related risks are mitigated anyway, right? And so it's really doing that skillfully, ensuring that those economic agents that require funding to be able to help with a just transition and an orderly transition to a greener economy are getting the right of you know, the kinds of financing they need. Of course, if they're able, you know, to carry that financing, we expect the banks to do that work. Thanks.
Excellent, Shaheen. Thank you. Welcome back, Shaheen. So we were worried we completely lost you. So let's turn to you now on that question on the bring together the different mandates or role of central bank and supervisor, and if there is tension between classical stability, climate-related risk, and financial inclusion.
Thank you very much. First of all, sorry, I had internet issue. That's why it dropped me. To be honest, I don't see any conflict between these two mandates. Like ECG risk is one part of the risks, and it affects directly through other risks, and that's why I don't see any conflict of interest within the like from the regulatory point of view. And it is one of the emerging risks and one important risk. That's why we are just making separately and making more focus on this, because the transition mechanisms are really complex compared to other emerging risks. That makes pushes us to make more focus on the issue, but I don't see it as a separate from other risk management. And after making, as I said before, we are conducting this stress testing project with the World Bank, and we see this as a part of the stress testing, whole stress testing framework. And we are going to make it mandatory for ICAP, ILAP, for the banks, in order to incorporate the same risks, those risks to their, let's say, internal capital and liquidity planning.
Okay, so we have 4 minutes left. I'm going to turn to each of you. So I want to come back to the scenario and the scenario you're using, which I think, I mean, that's a question raised, but a very important point. What do you use to be able to do that? So quick answer on that, and then any experience that is really fundamental that you want to share with your peers in terms of climate-related risk, financial stability. So let's start with Shaheen. 1 minute 30 seconds, then I'll turn to LZ, and then I will close.
As a scenario, we haven't conducted yet, as I said before. We are working on it. But we think that the scenario should be plausible for both the physical risk and the transition risk. For transition risks, we have some global patterns that we see is going, and we understand which sectors are going to affected more within the country. It's the mainly oil sector, and which is comprising around 40%. And due to the, if you see the fund of flows among the economic sectors, it's not only about 40%. Like almost all sectors have so much interconnectedness. Even agriculture, construction are really interconnected with the oil sector. So through fund of flows, we want to assess the whole impact. And this impact plus some sort of standard deviation more impact will be our scenario, our scenarios for stress testing. And for physical part, we are looking to the also in the earthquake. It's not part of the climate risk, but also in earthquake we did this. We look to the historical history. So what was the main most shocks within the history of Azerbaijan? And probably we are going to do the same formulating of scenarios for the climate risk as well. We are going to look to the floods, droughts, and how the water level is going to change, what was the main weather conditions in the past, let's say 120 years. That of course we will not have enough data, but we are also working with the we have the organization called Azer Cosmos. They have like also the huge data sets, and through collaboration with the other government agencies, we will come up with some scenarios and the impacts to the both in institutional level and also in the segmental level through SMEs and the corporates and the regions, also to the economic sectors. That's our vision. But as I said, it's the new topic in Azerbaijan, and we don't have that much track history to say that we did this and that's our solution. That's our result.
But share your experience as you're going through that, because I think that would be of interest to a lot of countries. Elsie, to you.
Just very quickly, like I said, we're still working on that. We have a climate with a baseline study, currently going on with the help of the French Development Agency. And based on that, we hope to work out some scenarios. But it should be pretty easy because we have some real-time occurrences that we should be able to prepare scenarios around. But it's early days yet, I should say.
Excellent. Thank you very much. So I think everybody's learning emerging market and advanced economy alike, and that's where the community of practices and experience sharing across countries, jurisdiction, and regulators is so important. A lot of that is happening, and I think it's really it's both super interesting what's going on, very challenging, but also it's not perfect. But sometimes going with second best is also a way to push the envelope. And that's why I also want to conclude by thanking the Toronto Centre, because this is exactly what these panels are about, which is to showcase experiences of jurisdictions. So two very different countries in that respect. So thank you very much, Shaheen and Elsie, for having taken the time and shared your experience. This is not the end of the story. A lot is going on. So I think we'll continue to do that. And Elsie, you want to say a final word? So I'll turn to you before concluding.
I know it's time, but just to say that I think we're used to thinking of the climate problem as an issue, as a problem. But I like to think of the opportunities that it presents to us as well. The opportunity not only for supervisors, but for other authorities working together to promote more resilient economies, more resilient financial systems. In Ghana, we're hoping that it also broadens and deepens our financial system. Already, we're talking about green bonds and developing a market for green bonds, developing a market for our banks to tap into global green funds so that we can hopefully fund some of the investments that are required to deal with some long-standing development challenges that we've had. And so if you think of it that way, then it also gives us impetus to think of all the tools we can put in place to make this not a crisis, but to make this turn the opportunities into something that's lasting for our economies and our financial systems. Thanks.
Thank you very much, Elsie. I'm sure that Shaheen will have the same story. What he said earlier about changing the whole economy that is oil dependent and moving it to something very different is both a challenge, but also a huge opportunity with major implication on the country, the jobs, etc. So again, supervisors are thinking risk. So sometimes risk we come with a negative, but there is a positive there and a lot of opportunities. So thank you very much, Elsie, for flagging that. And we are beyond time, so I'm going to get in serious trouble with the Toronto Centre. They are beginning to put things. This is the start of a discussion. Let's also watch very carefully what's happening at COP29. And thank you very much to Azerbaijan for hosting. A lot will be said about finance in that context, very relevant to the discussion. So stay tuned with the Toronto Centre and what's happening on the global agenda. And thank you very much, Shaheen and Elsie, for sharing your experience, and the Toronto Centre for organizing. All of this will be made available, so more to come. And please also pass the message and disseminate, because we are all working together on this endeavor. Thank you very much, everybody. Stay tuned and talk soon. Bye-bye.